Good morning. It's Jeffrey Christian of CPM Group. It's about 9:48 here in New York on Friday morning, the 8th of August. I want to talk about Comex silver defaults and silver shortages, but I'll also talk about, follow up some of this talk about gold resets a little bit later. Gold prices spiked sharply higher in the New York Comex this morning. They got up to $3,534.10 for the December contract. They come back down, and when we were preparing this about a half hour ago, the price was $3,482. The price in London at the same time was $3,394.95, almost, well, $90 less than in New York. So there's a very big premium right now for gold in the New York market relative to gold in London. And that spike up to $3,534 had to do with the fact that there were market reports or news reports that the U.S. government was going to start imposing tariffs on 1 kilo bar imports into the United States. And that led to this spike up. Somebody looked up and said, wait a second, this isn't that problematic, and the price came back off. CPM Group has been projecting for its clients that the price would touch 3,500 in August or September, and would probably get up to 3,600 in September or October, with higher prices later in the year and into 2026. The price continues to behave the way we have been expecting it to, and that reflects the economic and political environment and social decay that you're finding in the United States and really around the world. Silver prices have risen up. They're over $38 an ounce, and very similar pattern. They have lagged gold prices, and that has caused some consternation. I want to deal with a couple of the myths that people have, that if you understand the reality, you'll understand why the silver prices lag that of gold. First one is, there's no such thing as a silver deficit. That's all marketing hype. Anybody who tells you there's a silver deficit is adding proxies for investment demand to fabrication demand in order to show a deficit, in order to make the case to investors that the silver market has a shortage and you should be buying silver. The only people who will talk about a silver deficit are those who are marketing silver from a position of falsehood, or those who simply haven't studied the silver market. The information is out there. The truth is out there. But there's a willful negligence of people not wanting to look for it. That's a bigger issue across society right now. But the reality is there is no silver deficit. And if you're investing in silver predicated on the idea that there's a deficit and the world's running out of silver, you will not invest as efficiently and as effectively as if you understand the real market balance situation. Similarly, you have a record of more than 6 billion ounces of silver in refined above ground inventories. These are bars, 1,000-ounce bars and smaller bars, coins, and medallions. Medallions are unofficial rounds and small bars that are minted by private companies as opposed to governments. And that's important because when it comes time to sell stuff, if you've got a maple leaf or an eagle or a philharmonica, you've got a official coin that has a premium to the bullion market and has the imprimatur of the government that's minted it. If you have a round that has been produced by a private mint or refiner, it has less of a provenance. And when you go to sell it, you're going to wind up probably taking a discount to the spot market. And that is, in fact, what's been happening to a growing extent for the last 2 years. For the last 2 years, we have seen investors selling silver into the higher prices. And more than 100 million ounces of such small investment rounds and bars have been sold by investors back to dealers in the first 7 months of this year. And you're seeing that the dealers are more reluctant to buy that stuff. They're desperate to find people to buy it from them. They're sending it to refineries to have it melted down and cast into good delivery 1,000-ounce bars. And the discount to the spot price has grown. There is no shortage of silver. And if you're investing in silver predicated on the idea that the world is running out of silver because there's a persistent deficit, you will not invest as efficiently and as effectively as if you invest based on accurate market information. Now, I want to talk about the idea of a Comex silver default, because you keep hearing these guys talk about it. First off, let's start. What is a default? A default, as defined by the Oxford Dictionary and by various laws, is a failure to fulfill an obligation, especially to repay a loan or to appear in a court. And on a verbal basis, as opposed to a noun, it's the failure to fulfill that obligation or to repay that loan. So let's talk about what a Comex silver default would be, because all these people keep talking about it for decades. Comex silver is going to default. And when that happens, and the gold price rises sharply, and when that happens, the world economic system collapses. But none of these people can accurately lay out what a silver default, Comex silver default, would be and how it would evolve. And that's because it's highly unlikely. You see, Comex doesn't trade physical silver. Comex trades futures contracts and options. Some of those futures contracts can be settled for physical silver, but Comex trades silver futures contracts. And more than 99% of those contracts are settled for cash. Day in, day out, month in, month out, year in, year out, decade out, going all the way back, right? Comex has never defaulted. In fact, I don't know that any U.S. futures market has ever defaulted, right? Very few market participants actually want physical silver. They want exposure to silver prices. There are people, corporations, producers, refiners, fabricators, and trading companies and bullion banks that do want physical metal, and there's a constant settlement and delivery, and people take that physical silver. And sometimes they take it out of the vaults and they go and they use it in a product, or they store it someplace else, right? But the primary function of the Comex is to trade silver futures and options. And the Comex has rules and regulations that allow each participant, whether they're short or they're long, to decide what do they want to do with their contract. Do they want to deliver metal or take delivery of metal? Do they want to buy it back? Do they want to buy back their short or long position? Or do they want to settle for cash? And again, more than 99% of them say, I'll settle for cash. Comex has rules and regulations that allow that. Comex has rules and regulations for the orderly settlement of congested markets. One of the big erroneous statements that I've listened to for 45 years now is that the Comex and what was the Chicago Exchange at the time changed the rules on the hunts. They did not change the rules on the hunts. They imposed the rules that were already on the book. And one of the mistakes that the hunts had is they didn't pay attention to the fact that the Comex had the right to intervene and organize an orderly settlement if a market became, quote, congested. Comex also has a clearinghouse that ensures that shorts and longs have the financial wherewithal to cover their positions. They have that because they put up margin, either cash or, in the case of many bullion dealers, physical silver. That physical silver that's registered with the Comex clearinghouse, that is collateral against shorts and long positions. Comex has a clearinghouse that assures that if you're participating in the Comex futures and options market, you have the money there to settle. And the Comex clearinghouse has the capacity to protect itself and its participants should someone actually not have enough material or cash to sell it. That's why we have clearinghouses in financial markets around the world. And the clearinghouse has sufficient funds to cover any shortfalls by those market participants that break the rules and don't have the financial wherewithal to cover their positions. So the idea of a Comex default, think it through. How would it happen? A default, let's go back to that definition, is the failure to fulfill an obligation, especially to repay a loan. Okay, a default in the Comex silver market would not be going to cash settlement because that's in the rules. That's in the rules. Not only is it in the rules, it is the practice for almost all of the market participants. So think it through and say, guys, you hear these people on the internet talking about the imminence of a Comex silver default. How would that happen? And what would it look like? It's a joke. It's a joke, and the joke is on gullible investors. Now, propagandists will say, well, look at what happened to the LME nickel contract. Okay, first off, nickel is not silver. Silver market's a lot more liquid and broader, deeper and broader than nickel. Second thing is the LME is not a futures market. It is a principal-to-principal market. And the third thing is the LME is not under U.S. market regulations. So, it's like saying, hey, well, it's a deflection. And it's a distortion of what the silver market really is like. Oh, and then you have this other nonsense a few years ago. These guys who were like, it's the end of time and silver's going to be the only money. And I tried to take delivery of a single futures contract on the Comex. I went to a broker that only deals with futures and options, does not deal with physical delivery, and he wouldn't assist me in taking delivery of my contract. And they diddled around and they acted incompetently. We even reached out to them and said, hey, our clients take delivery of physical metal every day on the Comex. We can arrange for you to do that, and this could be settled in 2 days. They didn't want to do that because what they were doing was promoting the idea that somehow or the Comex was fraud. If you think Comex is a fraud, I can't help you. Let's talk to platinum and palladium. Platinum has come off some from its peak. It broke above 1,500, got up to about $1,504 a couple weeks ago. It's come off. We continue to believe that it will decelerate and possibly go back into a range of, say, $900 to $1,200 over the next couple months. That spike higher was based on a lot of speculative buying, predicated on an inaccurate understanding that the platinum market also was in some sort of fantasy deficit, and that Chinese consumers are buying jewelry hand over fist, and that Chinese imports has surged even though they were off in the first half of this year compared to the first half of 2024. So we'd expect that to normalize. And we also expect the palladium market to normalize. And in fact, the palladium market is already normalizing. It broke above 1,350 a couple of weeks ago. It's back down. It was $1,142 this morning. That was about $40, some odd dollars off from 3 days ago. It is moving back into that range that we've seen since late 2023. So that's what we have. Now, I want to talk a little bit about this Treasury resetting gold. We talked about that in, I guess, the Tuesday video. And there continues to be just flawed thinking. So this one guy said, could you elaborate on FDR setting the price in the mid-30s for 30 at $35 to 20, something in 1935. Actually, it was in 1935. Yeah. It was in 1933. And then this other guy, Kevin, said, nope, he won't. They're not even fiduciaries. So before I deal with the substantive question, which is a legitimate question to ask if you don't know what you're talking about, and I'm here to tell you and answer that question. But first, let me point out to Kevin that he ought not to speak from a position of total willful ignorance. CPM Group is a fiduciary, and I am a fiduciary, and we have fiduciary responsibilities to our clients. Not that that has anything to do with the idea that I wouldn't address the issue of the difference between what happened in 1933 and what these dreamers put out there about the Treasury resetting gold prices. So we'll talk about what happened in 1933, and we'll talk about what won't happen now. There's some big differences. Here's another question, interesting arguments about the gold revaluation theory. However, I believe, emphasis on belief, the proponents of this theory are not advocating either to buy or sell gold. They are advocating to revalue the gold so that the U.S. budget shows a surplus, which the government can then spend without issuing new treasuries. That's nonsense. Okay, there are several issues with this. And then there's no different from what Roosevelt did in the Gold Reserve Act of 1934. Okay, let's go back to 1934, 1933 to begin with. In 1930s, the world was on a gold standard. The U.S. government was on a gold standard. Governments and private institutions globally had agreed upon what that gold price was, and they traded constantly. One of the major jobs of the U.S. Treasury and other central banks during the days of a gold standard was to constantly, on a daily basis, buy and sell gold to maintain the gold price relative to their home currency, the U.S. dollar in the case of the dollar. Prior to 1933, the gold price was $29 or was it $29 or $22.79? I think it was $22.79. It rose to $35.20 when Roosevelt did what he did. He did it in an environment with a gold standard where the U.S. Treasury bought and sold gold at its official prices. At its official prices. It was buying and selling gold. That's important when you start talking about, well, what are the mechanics of the Treasury resetting gold? But there's another big issue with this guy's comments. The difference between balance sheet capital and current account flows. The Treasury and anybody else who has gold can say, my gold's not worth $3,400. My gold's worth $10,000 or $200,000. And they can do that on their balance sheet. If they try to use that balance sheet to borrow money or do other financial transactions, reasonable counterparties will say, no, your gold is worth $3,400 or less if you try to sell it and use that money. Right? So there's a current account deficit in the United States. The U.S. government is spending trillions of dollars more each year than it is taking in revenue. It has to borrow money by selling Treasury securities to cover the deficit spending. That's a current account balance, right? Then the Treasury has a balance sheet, which is the assets of the United States government, including 261 million ounces of gold. If it says unilaterally, I'm going to revalue my gold to $10,000 or $200,000, and that gold is worth more than my $38 trillion worth of debt, therefore, I have a positive balance in my balance sheet, that's meaningless to the current account deficit. It only affects the current account deficit if the government sells the gold at $200,000 or $10,000, right? So people say, well, they'll revalue the gold, but they won't sell any. Well, in 1933, the Treasury was able to increase the price of gold because it was buying and selling. And it was saying, okay, we're not saying that the gold price is X anymore. We're saying it's $35.20. And if you don't believe me or don't agree with me that the price of gold is $35.20, you can come and sell me your gold for $35.20. I'll buy it at $35.20. Or I will sell you gold at $35.20, right? So you can only really affect the price up away from your own money. You can only affect the price if you actually transact at that price. So the Treasury could say, we're going to make gold $10,000 an ounce. And everybody says, that's great. I have gold. I'm going to buy gold in the market at $3,400, and I'm going to sell it to you at $10,000. Treasury, oh, no, I'm not actually buying it. I'm just saying the gold's worth $10,000. So, yeah, okay, fine. So that's a fraud, right? Yeah, it's just like, that's a joke, right? That's like writing yourself $1 million check so you can say, hey, I have $1 million check. Or you could say, I'll sell you gold at $10,000 an ounce. And people say, why would I buy gold at $10,000 an ounce when I can buy it in the market for $3,400? And if you're sitting on 261 million ounces of gold and you're willing to sell it to reduce your debt, that's going to have a very big negative effect on the price. So you're going to get out of there, right? Price is not going to be $3,400 if the U.S. government is willing to sell 261 million ounces of gold. So to say that you're going to revalue gold, but you're not going to transact at that level is just nonsense. It doesn't work that way. The U.S. government can say, I'm going to revalue my gold at $10,000 or $200,000, but it has no capacity to tell other governments that that's the price of gold, or participants in the gold market around the world, not only in other countries, but also in the United States. The U.S. government has no capacity to unilaterally revalue gold for anyone other than itself unless it's willing to make transactions at that new price. Buy or sell. It has to be a market maker, right? And if it revalues and it's not buying and selling, that's a paper revaluation that's meaningless to anybody else who might want to borrow money. And because it's such a stupid idea, it would reduce your creditworthiness and increase the interest rate that you're going to have to pay. So another guy said, I don't agree with you. The government would do a revaluation to say $10,000 and all gold moving forward would be at $10,000. They wouldn't sell any. They'd just say, hey, the price is $10,000. Right? It doesn't work that way. How does the government revalue gold to $10,000 for anybody other than itself? If it offered to buy gold at $10,000, that would do it. But then it would have to continue to buy gold at $10,000. Gold says, oh, I'm going to buy gold for $10,000. I'll buy $100 million worth of gold. People will sell it $100 million worth of gold at $10,000. And then says, okay, fine, I'm done. The price goes back to $3,450. Right? In the absence of ongoing purchases, that revaluation means nothing to the market. Yes, government passes a law stating that any gold bought and sold in the United States has to be sold or bought at $10,000 per ounce. That drives all gold transactions either overseas or underground. Now, we used to have a gold standard. We had it, basically from the end of the Civil War until, I guess, 1971 or so. And it's interesting because if you look at, well, what did the price of gold do during recessions and periods of hyperinflation and depressions? We had depressions in the 1870s, 1880s, and 1890s, as well as the 1930s. We had 3 decades where we had depressions, not recessions, depressions, right? What happened to the price of gold in those depressions? And you look at the records and say, oh, the price of gold was $22. Yeah, it didn't change. No, the official gold price didn't change. But the real price in the market, if you read literature, you find people buying and selling gold all over the price. Yeah, that's the official price, but here's the price that I'm making a transaction at. It just doesn't make sense. And one last comment. Jeff, quit blasting your audience and get to the point. I think he's saying that I'm being critical of my audience, and I'm not. We have an audience, 14,000 or whatever subscribers, 14,000 views often on our videos. And I'm not criticizing those people. Those are very smart people. I have incredible respect for them. I criticize people who cannot think critically or who speak from a position of ignorance of facts. Yeah, Bernard Baruch famously said, everyone is entitled to their opinion, but no one has the right to their own set of facts. That's an axiom that is under attack in the world today, in the United States today. It's always been under attack, but the attack is much more virulent. The opponents to truth have more weapons, and they're using them than ever before. The ignorance of facts is a bad thing. Negligent ignorance is a crime against humanity. I don't criticize our audience. I love our audience. I am very happy and proud that there are a lot of people who say, oh, this is really good information. This is accurate information. You have made sense. I now understand why the silver price is not rising as strongly as the gold price. It's because there isn't a deficit and there isn't a paucity of silver. The world's not running out of silver. In fact, investors are selling more than 100 million ounces of silver to take profits at $35, $38, $39 an ounce. I like that kind of audience, and I would never bash it. However, if you want to talk and throw out your beliefs and your opinions without thinking them through critically or speaking from a position of knowledge, I think you're fair game. That's all I have for today. Take care of yourself. Take care of those around you. Have a good weekend. Do something good for the world. You can go to our website. You can buy our gold, silver, platinum yearbooks. Get some accurate research, not marketing hype. We're not selling precious metals. We're selling research and analysis and consulting services. We try to help people make more money or save more money or protect more money in precious metals and commodities through knowledge, accurate research, accurate data, accurate analysis. You can also send us a note at info@cpmgroup.com, and we'll start a conversation about how we can help you. Take care.